I'm Charlotte McLeod with investingnews.com, and here today with me is Adrian Day, president of Adrian Day Asset Management. Thank you so much for being here. Great to have you.
Well, thank you, Charlotte. Good to see you again.
Good to be catching up with you, of course, as always, and it's nice to catch you so soon after the latest Fed meeting, because usually the Fed comes up in our talks.
Yes.
So we'll talk about them again. We got, they left rates unchanged, which I think was widely expected. I wanted to check in with you and see if there was anything that stood out to you in the statement or in the Powell comments afterwards.
Yeah, not really. I think it was more or less as it was expected. I mean, a lot of people have said it was a very dovish press conference. I'm not sure if that's true. Powell, you can tell Powell is trying very hard to get across the message that inflation they're going to keep on until inflation's beaten. But there's always these nagging considerations in the background that are holding him back. So, yeah, there was nothing really outstanding to me.
Yeah, I think I've been hearing that from quite a few people. So, yeah, let's look at, I think what people are wondering now is the Fed done hiking? And let's get your thoughts on that.
Well, the interesting thing is they just released another dot plot, where the Fed members, the 19 members of the FOMC, say what they're expecting. And 12 out of 19 are still expecting another hike this year. That's as of Wednesday. That's right now, they're expecting another rate hike this year. I think the Fed, and I think Powell in particular, would like to have had another rate hike just to show, hey, we're really serious. But the war intervened, and now you've only got December left. So maybe they will, maybe they won't. In some ways, to me, that's not the important point. The important point is how long will they keep rates at their current level. So frankly, if they go up another quarter point to 5 3/4, it's not a huge deal one way or the other. The important thing is how long they keep them high. Because as many people keep emphasizing, Peter Boockvar among them, one of the smartest economists out, higher for longer is tightening. Because as you keep rates high for a long period of time, more and more companies, more and more households get into that higher interest rate vortex. So you only have to look at, for example, corporations. So you look at corporate debt. And relatively little corporate debt came due this year. But you look at next year, it's almost twice as much comes due. And if you look at 2025, it's another 50% on top of 2024. So if they keep rates high throughout 24 and into 25, then more and more corporations who've escaped the higher interest rate, it might affect their customers, but it doesn't affect their balance sheet. They've escaped it because they rolled over their debt for 3 years or 5 years or whatever it was. More and more corporations are bought into and have to refinance. And if a company, a good quality company, refinanced 5 years ago, they were probably paying 3% maybe. Now they'll be paying 8%. They're paying double, more than double.
Yeah, and another topic that we have touched on before is the lag effect, right? So I wanted to bring that up, and I think we had said, it takes 18 to 24 months to feel the effects, and it seems like we're coming into that 18-month kind of time frame. So,
yeah, absolutely. And again, this is a theme that I've that I've mentioned many times in many of my talks. Everybody, investors, economists, politicians, we're all impatient these days. We all expect things to happen, especially if they're inevitable. We expected the inevitable to happen much sooner than we should. So I did some work on, I've always said 18 to 24 months, as you just said. Well, I looked at all of the recessions going back to the 1960s. And if you look at the time from when the Fed first raised rates, the initial rate hike, to when the recession started, it's an average of 22 months. So that's the average. And I would posit that this one should even be longer. And it should be longer for two reasons. Sorry, what's the first one? Oh, the second one. It should be longer for two reasons. we had an extraordinarily long period of excessively easy money. That enabled households and corporations to repair balance sheets. We also had the COVID handouts. And so people have refinanced. People refinanced mortgages, corporations rolled over debt. And so, virtually everybody in some way or another took advantage of the zero interest rate environment. Of course, we didn't pay zero, but they took advantage of a zero rate environment to extend their debt and to lower the interest rates. The only institution that didn't, of course, was the U.S. government, which I think is criminal. I think it's criminal that the Treasury Secretary, when rates were zero, and negative in Europe and negative in Japan, and the U.S. was clearly the most dominant economy in the world, why the Fed didn't issue more 30-year bonds, let alone 50 and 100-year bonds. My goodness, if Austria issued 100-year bonds, if Italy and Argentina, of all places, could issue 50-year bonds, surely the U.S. could have. But of course, they didn't want to issue a 50-year bond because they'd have had to pay 2.5% as opposed to 0.25% on short term. So anyway, the point is there is a much, much longer runway now. People's balance sheets are stronger. The second reason I've remembered, is, yes, you can look at when rates start hiking, but it's also important to look at when rates go positive. And rates didn't go positive till June, July of this year. So we've only had positive real rates for a few months. So I would expect that 22 months, which is the average, to actually be longer this time. And we're not at 22 months yet. So people who think we're going to have a soft landing because we haven't had a recession yet, I think, well, they haven't studied history, but they're also just living in cloud cuckoo land, in my view.
Okay. I'm going to check back with you again then. We'll probably see each other in January. I'll check back with you and then about what's going on.
Where it will be 21 months.
Okay, not quite. Not quite.
Still a little.
Okay, you're off the hook until maybe, we'll find you then and see if the effects are coming through. Okay, so this is all really interesting. And so you started to talk about bonds, and this is the bond situation that I hoped you could help me understand a little bit better. So from what I understand, at a really basic level, we've got higher interest rates pushing up the bond yields. This hurts prices. And then I wondered if you could help break down what's going on, maybe talk about how this situation plays out as we go forward.
Okay. Well, of course, and everybody knows that higher yields mean lower bond prices. So that's always, sometimes when people say bonds are going down, they said, no, my bonds are going up. No, the yield's going up, the bonds are going down. Okay. So we have a situation now. To me, it's a basic, a primary thing is supply and demand. You've got a huge increase in supply of treasuries, and that treasuries is coming from this year and next year. That supply is coming from three factors. One is the increase in the deficit, so the government has to issue more bonds to cover the deficit. The second one is that we had a moratorium on issuing treasuries during those government lockdown negotiations, the debt ceiling negotiations. Sorry, I get all these panic negotiations confused. The debt ceiling negotiations early in the year, so the Treasury couldn't issue any treasuries during that period. So we have a catch up, and that catch up, is as much as another $1 trillion of bonds before the end of the year. And then the third factor is the one I just mentioned earlier, which is the Treasury issued at shorter maturities. So if the Treasury's been issuing a 1, 2, and 3 year maturities, obviously we have more Treasuries maturing this year than we would have if they had issued a 30 years. So put all those things together and you have a much higher supply of Treasuries than we have for the last few years, at the same time as we got a lower demand. And the lower demand comes from, if you look at what have traditionally been the largest buyers of treasuries, the Fed, number one, people don't realize the Fed is the largest buyer of treasuries. Well, the Fed with QT is not buying treasuries anymore. Then the second one is the large foreign buyers. If you look at the largest foreign buyers traditionally, it's China, Japan, and Russia. Well, Russia's not buying any anymore. China's not buying anymore. They're not heavy sellers, but they're not buying. And Japan also has turned very small net seller. When the Japanese economy is a tangent, but when the Japanese interest rates move a little bit into positive territory, a lot of Japanese institutional money, insurance companies, corporations, have put their money abroad for the last 10 years, are going to bring it back. When they bring it back, that means they're going to start selling treasuries. But for now, you just have the Fed not buying, the largest foreign buyers not buying. Who comes next? U.S. banking system? Well, the U.S. banks are not buying a lot of treasuries right now. A, they don't have the money because people are pulling the money out to put it into money market funds. And secondly, they saw what happened, the cause of the banking crisis back in April. So there's banks in the U.S. are buying less. I'm not saying they're not buying any, but they're buying less. And so the treasury market is dependent upon pension funds, insurance funds, hedge funds, a lot of hedge funds in the treasury market, and they're simply demanding a higher yield. They're demanding a better price before they buy. And so we've seen in the last 2 weeks, last week we had a 3-year, 10-year, 30-year, all of which, I won't say they failed, but all of which were considered very bad auctions with very long tails, and a lot of the bonds were kept on the books of the dealers. I don't know if you know how it works, but there's a bunch of treasury dealers who sell the bonds, guarantee that they will be sold. And if they're not sold, they remain on their books. And so the percentage that remained on their books was much higher than normal. This year this week, I think it was a 2-year, 2-year, 5-year, and another 10-year, I can't remember. But 2 of those 3 were also bad auctions. So the point is the market, both at the short end and the long end, is demanding higher interest rates. People do not want to buy long-term or even medium-term treasury bonds, unless they're compensated for it.
So I think what we should take a look at now is, we've talked about all these different factors going on in the broader markets. Can we relate it back to gold and what's happening with gold?
Yeah, no, absolutely. So, basically, I think it's very, very clear that a recession is coming. A lot of people, when you say recession, they automatically assume gold's going to do badly. In fact, again, if you look at all of the recessions back to the 1960s, gold itself, gold bullion, gold went up in every one of those recessions except one. And the one that went down, it went down less than 0.5%. So not a lot. So gold has typically done very well in recessions. If you look at gold stocks, the gold stocks were up in every one. There's 9 of those recessions. They were up in 6, they're down in 3. So on balance, they've done pretty well. But even in the ones where they were down, they beat the S&P. So the lesson from that is that gold will probably do well in a recession. Gold stocks will probably do well in a recession, but they will also probably beat the rest of the market. And I'll just, I hate it when people play with statistics to get the answer they want. Was it Paul Krugman's got this wonderful new inflation measure that excludes not only food and energy, but I think it excludes, it excludes housing as well. And if you don't eat, drink, or power or light your house, what's the problem, guys? Everything's fine. But I will say that if you started your measurement of that of what I just said, if you started your measurement 1 month after the recession started, then the gold stocks were up in every single one. So, and that's logical when you think of it. When a recession starts, people are moving out of stocks, and they're moving out of volatile stocks, cyclical stocks. So gold stocks get hit. But then when people look for a safe haven, they come back into them. So anyway, gold stocks, I think, if we have a recession, I don't think we should be afraid of gold and gold stocks. Now, of course, I've forgotten what the question was.
Oh, we were just talking about where was gold going to go on all of this. Yeah. So I think you did answer the question.
So, that's from the point of view of recession. You've got higher interest rates, and higher interest rates, the market demanding higher interest rates. That's not historically, that's not necessarily a negative for gold at all, though people think, high interest rates bad for gold. What people think is a positive for gold, namely wars, turns out to be much less of a positive than people assume. And, you know, you can look at the last 30 years, or the last 40 years, in fact, and geopolitical events, however serious they are, they tend to have a positive effect on gold, but they tend to be very short-lived. That was true of 9/11. It was true of a Russian invasion last year. We had a spike when gold moved up a week ahead of the invasion on anticipation. We had a spike when the Russian tanks started rolling over the border. Within 3 months, gold was back to where it was before. So the geopolitical spikes tend to be very, very short. So that's not something we should... Well, first of all, I mean, just as human beings, we don't want to hope for tragedy in order for our gold to go up. But just an investor, that's not something we should pin our hopes on, our expectations on. It's more the dollar, interest rates, the economy. These are the things that are going to affect gold.
Right. And okay, so going back to the conversation we had in July, this fits with what we were talking about then. You mentioned you saw the best value at the time in gold stocks. You also mentioned oil stocks, which I didn't follow up on at the time, but I wanted to just check in with you on oil stocks as well, because we know in the gold space you really like royalty companies. What's your thoughts on oil stocks?
Well, I think, again, I'm not an expert on the oil business. I think for most investors who are not, you know, dedicating half their life to studying something, like a lot of people here are looking at the gold stocks day in and day out, I think you are better off sticking either with the big international diversified companies like Exxon or Chevron, or the royalty companies. One we own, for example, is one called Dorchester. It's an LP. Now, that's the problem, you know, in the oil space, most of the royalty companies are limited partnerships. Some investors just don't like limited partnerships because you get those K1s that you have to put on your tax return. And, you know, I mean, most people these days have an accountant, so it shouldn't really be a big deal. You just say to your accountant, hey, I got a K1. Let them deal with it. But a lot of people just don't like it. But in the oil space, most of the good royalty companies, most of them are royalty companies. So the one I just mentioned, Dorchester Master Limited, Dorchester Miner is called, Dorchester Miner Limited Partnership. DMLP is a symbol, trading around $28. That's got a current yield over 12%. And it's a well-run, good quality, conservative. You know, let's not forget these are wasting assets. But this is not at the end of its life by any means. That's another thing. I'll just make a tangent. People know this, but they forget it sometimes when they're buying things. You know, anytime you're investing in something that's a wasting asset, it's really important you look at what's the expected life left. You don't want to buy something with a 12% yield and then find that, you know, it runs out of oil next year, obviously.
No, it's still a good point, still relevant for people to remember.
Well, you forget, you get excited. 12%, wow, let's buy that. But yeah, but I'm not buying much in the oil space right now because I think a lot of the oil companies have just gone up a little bit too far, too fast. I mean, obviously, oil has moved dramatically. Oil was already moving, of course, before the Hamas terrorism incident, but it shot up after that. So I always hate to chase prices. When you see something shoot up like that, you know, the likelihood is that it's going to settle back at some point. So I would just pause a little bit. The other thing that makes it very difficult, and again, people don't always think about this, but when you're looking at cyclical industries, mining in general, as well as oil and gas, if you're a fundamentalist investor like I am, a value investor as I am, you can get very confused because the multiples will tend to be very high when the stocks are actually at their low, and the multiples can be low because the cash flow increases. So the cash flow increases more than the price of a stock. So at the top, the multiples will tend to be low. And so as a value investor, you can sometimes get a bit tricked by that and see low multiples and think, oh, well, that must be a good buy. Similarly, you see high multiples and think, well, I'm not going to buy that. So the multiples on a lot of these E&P companies, exploration and production companies, the smaller ones, are quite high right now. But I think a lot of them are in a bottoming phase. The thing to really look at to me is about balance sheet. How long can these companies last? How long can these companies last before oil and gas prices are sustainably higher? Now, of course, we have good oil prices right now. We don't have good gas prices.
Okay, thanks for going into that. That was interesting. I think as we are wrapping up, I just want to check in and see if you had any advice that you would leave investors with at the moment.
Yeah, I guess two things. One is, as I said, just, if you have a scenario that makes logical sense to you and it seems inevitable to you, don't get too impatient. Things always take longer to play through than we expect them to, always. That doesn't mean you have to be stubborn and refuse to change your mind, but just be patient. And I think if you're buying, I'm now talking more about the seniors, but the other thing I would say is if you're buying the high quality senior miners and royalty companies right now, don't get up, be patient. Don't get upset that they're not moving more rapidly. Well, they're moving, but in the right direction. If you buy Agnico under 50, you're buying a great company at a great price. And in 18 months or 24 months, you're going to be very, very happy you bought it. And whether it goes to 46 or 49, just don't get wrapped up in that kind of stuff.
Okay, I think that's a nice place to finish it up. We will check back with you when those 22 months come. Let's see what you have to say. But thank you so much for coming on to talk about what's going on in the market.
Oh, well, thank you very much for having me, Charlotte.
Of
Good to see
course.
you.
And once again, I'm Charlotte McLeod with investingnews.com, and this is Adrian Day. Thank you for watching. If you like this video, make sure you subscribe to our channel. We'd also love to hear your thoughts, so leave us a comment below. We'll see you next time.